Lauren asked in the Discord if we could record it. Sounds good.
Cool. I'll stop cussing. Okay, so you guys can see the PowerPoint that I have up right now, right? Okay, yeah. So it's really bare bones slides, but wait, how do I present this thing? Okay.
Oh, here, switch. You're screen sharing the wrong one now. Yeah. No, that's the right. Like, you did the right presentation thing, but you have to screen share the presentation rather than the
Okay.
presenter's view. Does that make sense?
Yeah.
Yeah. So either I think you can just switch the two. Yeah, there you go. You got it.
Is it good now?
Yeah, it's good now.
Okay. So yeah, basically we're gonna be talking about the wheel, which is it's a way that allows you to invest, like entering positions by mostly you take profits from selling options instead of buying options. Most people, when they get introduced to the concept of options, they think more on the buying side. So buying calls and buying puts, taking risk in those directions. And this is kind of the opposite of that. So yeah, basically sell options instead of purchase them. And the point is you collect a premium instead of paying for a premium, or paying a premium to get a share. So you allow the theta, which is a Greek of the option, to decay. And theta basically represents the time to maturity, or like the time value of that option. So the longer an option has, the more it's going to be worth. But over time, if that option does not go in the money, then the option loses value. And because you've sold it, you're just collecting profit. So the idea, yeah, is it's smaller positive returns each month that compound, and it's typically a less risky strategy, and it's not necessarily going to outperform the market better than like buy and hold in terms of value, but ideally there's less risk involved. But it depends on how you do it and what stocks you do it with. Okay, so call versus put options. This is basically just like what they are. It seems like people have a pretty good understanding of what a call and a put option is. I made sure to include that, like, most people think of just buying calls or buying puts, and what we're doing here is the opposite. And so you're in a call option scenario, you sell a contract for a premium, and now you're obliged to sell shares to the owner of the call option at whatever certain price is agreed upon if they exercise, which they will if it's in the money. So I'll get into an example in a little bit, but does that make sense to people? Like, are you guys tracking?
And then are you assuming are these covered call and sell and put options that you're talking about?
I'm not there yet, but
Okay.
yeah. But does anyone have any questions about like just basics of like a call or a put?
Wait, so short call options and short put options, those are completely different than shorting. Am I correct? Just want to make that clear.
Yes. Yeah, but
It's the wording gets confusing. That's why I wanted to make sure.
right. Yeah. No, if you're short a call, that means you're selling a call or writing a call.
Oh, okay. I see it. So yeah. So on the sell side, it's called shorting the option, but
Yeah.
if you're shorting the stock, it's borrowing it instead. It's a different thing. Okay,
Mm-hmm.
that makes sense.
Yeah. No, that's a good question. It is confusing, and like when people learn about options, they really only learn about buying them, which I think is really oversimplified. But yeah, okay. So we'll move on, and what the strategy is, and this has a lot of jargon, but I'll try and break it down as easily as I can. And I did put in like a Reddit that has that explains it maybe a little bit more clearly than I do. Uh, Basically, you're gonna sell an out of the money put with 30 to 45 days to expiration, and this is going to be a cash secured put. What that means is you have cash on hand, like in your brokerage, that um, you have enough cash so that if it expires out of the money or in the money, sorry, um, you can buy you can buy 100 shares of the underlying at this strike price. So basically, like what this does is it allows you to basically establish a price. You say, okay, I'm going to buy this stock at the if it goes to this price or lower, and you're going to buy it at this price. So it's essentially setting a limit order, um, but you collect premium to do it. So that's kind of how you get into the wheel. That's how, at least that's how I would start the wheel. And ideally, in an ideal scenario, basically that stock kind of stays in the same place. Maybe it goes up a little bit, and the theta of that option decays. So the value of that option diminishes, and you can buy to close that option for cheaper because the option has just lost value. So you're selling it at one price. Ideally, you're buying it back at a higher price. Sorry, at a lower price, and you take like 50% profit, rinse and repeat, and you kind of keep your hands clean. Occasionally, the stock moves against you, and you are forced to, well, let's just say you accept being assigned those shares. So then you get 100 shares. So then now you're in the next stage of the wheel. So now you've bought 100 shares of this underlying, and what you can do from there is sell a covered call. And what that means is you sell an out of the money call, again, typically with 30 to 45 days till expiration. That just gives you enough wiggle room, like enough time. And sorry, I can hear my echo because my roommate's also in the club. You hear, oh fuck. Now I'm thinking about it. You sell the call, and then if it goes against you, all that happens, which means that the stock price goes up to a certain level, then your shares get called away because you've been obliged to sell to the owner of the call. And then you collect your premium and you get out of the position, and then you're fine. You walk away.
I
And like
see.
you value on the upside, but what's that?
So you're when you're selling a call, you're basically setting a limit order at a sell price that you're going to sell
Yeah,
at to the person who buys it, but you're also getting the premium on top of that, right? So
exactly.
worst case, you sell at a high price. Best case, I guess you just collect money on your shares, pretty much.
Yeah,
Am I wrong?
right. The worst case is obviously that like if you have those 100 shares, then and it goes down a lot, then I mean you're just bag holding at that point because you still own that 100 shares. Your covered call has
Right.
made money because like you collect that premium and it's going to expire out of the money, so that's great. But you do lose money from the underlying.
Yeah,
Um,
yeah, I see what you mean.
but it's the
But
same
you're losing less
risk
money than you would have just holding the
because
shares,
you've
pretty
got
much.
that premium. Yeah,
Yeah.
because you've
Okay.
lowered your cost basis by selling these options. Um, and the downside is never going to be like greater than just buying and holding. So that's why pretty it's a pretty risk averse strategy, or it can be. Um, but you can get screwed and you go in at the wrong time. It does require a little bit more timing and like expertise in that regard, I would say. Does anyone have any questions about this stuff?
And could that be something too, where you set a really long or really like a I guess an unrealistic price target um, that you'd be fine selling at a position you already have, and so you sell a call on that and collect the premium. It probably expires worthless.
Yeah,
Is that also just a strategy where you don't even need to do the puts, but you just sell the covered calls as well.
Selling covered calls is definitely a strategy. Problem is that if you sell covered calls that are far enough out of the money, you tend to just take like tail risk at that point, and you don't make a lot of money on the premium. But like in the case of an extreme event, you're gonna get screwed.
I
And
see what you mean. Yeah,
it's not
because
very well
like
compensated.
like if you're long on something and then you set a price target and then it moons and then you miss out on the rest of the gains and then you have to sell at a certain price essentially.
Yeah,
Okay.
yeah, yeah, that's right. So I have kind of gotten like this strategy. I think I have another slide. So yeah, so some choices that you can make is like what um, what stock do you want to pick? Typically, people would recommend something that you're bullish on. But if you're super bullish on the stock, like the only thing that you should be doing is buying the shares or like buying a call or something like that. Um, those are the most straightforward plays if you just know something's going to go up a lot because this is going to limit your gains pretty severely. Um, you can decide what delta, and this is an equate or the definition or one definition of delta. There are a handful, but it says like the probability that the option expires in the money. Um, and so if you take a higher delta stock, that's going to be more risk, or a higher delta option, that's going to be a lot more risky. Um, and then days to expiration, like how long, I say 30 to 45 days, but that's just personal preference. And then if it goes against you, do you accept assignment? Um, there are ways to like not get assigned shares, so you can just buy back your put and then sell another put that's further out and maybe further out of the money or closer in the money, so you can like not take any losses. Like there are ways to do that, but it just kind of extends your risk. It depends on if your investment thesis has changed or not, but typically it's a stock that you're fairly bullish on that's like pretty stable, but the higher the implied volatility, the better the premiums you're going to collect. So it's all up to the investor. You can make this a really risky strategy, or you can make this a really risk averse strategy. Like the past few days, people are getting screwed, but that's kind of the nature of it.
I see, because the prices are changing so much they're missing out on that, I guess is what you're saying? Or like just
They're missing out, and prices are moving against them. So, like, if you sold a put, let's say a stock is trading at $20, you sell a put at like 19, and then it goes to 12. Um,
oh, you still have to buy a 19 though, right?
yeah,
Oh. Oh, yeah.
right.
Can see
But I
that
mean, also
in your home.
at the same time, like if you had bought at 19, it's the exact same thing, except for you didn't collect the premium.
Yeah.
Um, but yeah, so like there's definitely risk involved. I think those are, yeah, I think that's all I had. Um, so hopefully this was like interesting to some of you guys. Um, and let me know if anyone has any more questions. I think it's pretty interesting to talk about and learn about. Yeah.
And then is this something that you should probably know all the Greek symbols for, or is it something that, because I guess those always confuse me, like the theta, delta, gamma, kappa.
Mm.
I don't even know. I don't even know the ones.
Yeah, like I think it's definitely um advised. It's maybe not like entirely necessary to know every one. But I'd say that like it's good to know where you're taking risk. Um and those can kind of help you with that. Gabriel, you might be able to have a better answer than me on that because I think you probably
Yeah,
know the.
these. Oh, I was for this particular strategy. What I know about it is that this is usually for like more sophisticated investors who are trying to generate income over time
Mhm.
and limit their tail risk. So that
Yeah.
they sell covered calls like when when the price is really high just to generate income. And that's what I know about it. So this is like for high level investors. This isn't necessarily for like
Yeah.
making money quick.
Right. It's not, yeah, it's like, yeah, a YOLO here would like kind of really not make sense. And yeah, exactly. Like you can, if you have a pretty big portfolio, the premiums you're collecting are like a lot of cash. Um, so yeah, you can really just like make income on this, but it's not like trading like we discuss where you're super actively taking positions. Yeah, I agree with that feedback.
I posted a link to Spot Gamma website on the chat. That's like my favorite website for remembering like Greeks and stuff. They have like a really good educational series. If you want to check it out. Anybody who's confused.
Yeah, I need to learn about the gamma squeeze a little bit more.
Yeah, those guys are really good. There is like membership is really expensive, but they provide like gamma information on all stocks if like you pay obviously for the subscription. But I have a friend who like has a subscription and he gives me all the info for it. It's really helpful.
That's dope.
Nice.
Yeah.
Jeremy, maybe that could be a tool that we could, if we have like funding from the school, we could.
Yeah, it's so the registration should be completed. It just takes a couple weeks to get back to me, and then once that happens, then we can figure out funding for like T-shirts and stuff like that, and then also subscription services. So it should be pretty soon here.
Well, I think that's all I had. So I'm gonna stop sharing.
Yeah, thank you. Appreciate it. All right.
Yeah, I'll definitely sell covered calls on my Planet 13 shares one day, but they're not even listed on the NASDAQ yet. So, they're still OTC. So I don't even think you can't even do options on the OTC. I don't believe. Maybe.
I don't actually know. I haven't really messed around with.
Yeah. Because I know
like,
they don't have
non-standard.
after hours, so I'm assuming they don't have options. But yeah.
Yeah, I couldn't tell you.
To this guy. So last thing I just want to talk about really quick. We're looking for new people to start spring quarter and then through next year. It hasn't typically been done like this, but I think it's going to be better in the future if we get new people on for spring quarter and then have them be used to it by the time the new year starts. So I have an application that I'll throw in the chat and I'll also put in the Discord and probably send out an email later today. But if you guys are interested, I said, why apply? It's a great chance to help, CPI become a bigger, more inclusive club. I like this year how we're getting more students from other colleges and not just the business finance kids. It makes it a lot more interesting. And, usually you guys know, quite a bit more about options or some kind of crazy trading techniques. So that makes it interesting for sure. Always updated with the latest news and trends, being in a role on the board, like you're pretty familiar with what's going on, in the real world. And that's something to, talk about in interviews when people ask you. And then the last thing I said is just a great resume builder, man. This is, it's a good chance to get some leadership experience. And, this club could be really kind of whatever you guys want it to be. And, it's been tossed around into different ways throughout the years, but, it'd be awesome to have a new team that could really push this in the following years. There's just some like examples of positions that we were potentially looking for, but we're pretty open to, any other recommendations on positions or if you wanted to help out with something specific. But I think the term of this would probably go spring 2021. So starting in a couple weeks and then ending, now next year. And I'm probably going to leave those open for about a week. But please apply if you're interested, and we'd love to have you. I think other than that, we could talk about some current events today, but I don't have any other slides on those.
Thanks, Jeremy.
Yeah.
Thank you.
Yeah.
Yeah. I don't think the stimulus bill doesn't come out till April, right? It's April 4th ish.
I'm not totally sure on that. I have been seeing a bunch of news about it, but I don't know the timeline.
First card sent April 5th. Oh yeah, that's right. They have EIP cards, but then they also have direct deposit checks. Yeah, my parents got one of those weird debit cards.
Does anybody have GameStop shares in real life?
Yes, I do. I still
You
do. Yep, diamond hands.
Nice.
I mean, honestly, I just want to be a part of it, but I definitely bought too many. So I definitely got hit hard at the start, like in the middle where it kind of tanked. But I was holding them onto them for a while, so we're still
Yeah.
doing well.
I think it's at like 250 or something like that.
Yeah, that like, and I had just opened my individual brokerage account. Yeah, I think it's still like a gamma squeeze or something, whatever people want to say it is now. I don't even know.
236 right now.
Yeah.
I was looking at the options chain for it. I'm not invested. I don't have. I'm okay. But
Yeah.
I was looking at the options chain, and I was on like July $50 puts are trading at like $230. It's something crazy like that. Like
Yeah,
the
I had
people,
looked at
like
it
market
like,
makers are making so much money. It's crazy.
yeah, which is crazy that they had to shut it down at that one point though, because they were making a lot of money,
Yeah.
right?
Yeah, market makers are
But
making
it's just
so much money off this. It's ridiculous.
because I remember like the first day when it came back in a sense,
Yeah.
after the congressional hearing, and I think the options were up like 44,000%, like in a few hours, and I was like, wait, like stock's up like 10%. I don't know what's going on here, but like the options prices are just so weird.
Yeah.
The second I looked at it, I was like, I'm out of the options, even looking at it. Yeah, no, the DFV on the subreddit bought 50,000
Didn't
more
he double
shares.
his shit? I heard that he like
Oh no,
doubled it.
now he's up like 6x in a week.
That's so
Because he
sick.
bought the guy at the congressional hearing, the congressman was like, hey,